Imagine this. A tech company backed by the mighty Nvidia, hailed as the future of AI cloud infrastructure, suddenly crashes. Investors stunned, analysts divided, and Wall Street holding its breath. That company, CoreWeave. Once a rising star, now the center of a sharp sell-off. So here's the real question. Does this sudden drop signal a deeper issue with AI investments? Or is CoreWeave's crash the buying opportunity smart investors have been waiting for? In this video, we're breaking it all down. Welcome to Dividend Dreamer, where we turn market chaos into clarity. CoreWeave isn't some random tech startup. This Nvidia-backed startup has been a key player in the booming AI infrastructure space, providing the computing muscle behind artificial intelligence innovation. Its rapid rise, followed by this recent tech stock crash, has left many scratching their heads. Is CoreWeave still a growth rocket, or is it just another overhyped tech name falling back to earth? Stick around as we explore what caused this drop, what's happening behind the scenes, and whether it's time to cut losses or start buying. Let's rewind. CoreWeave started out in 2017 as a crypto mining company, but as market tides shifted, they pivoted into high-performance cloud computing, specializing in workloads that power artificial intelligence and machine learning. With Nvidia's support, both in terms of hardware and funding, CoreWeave quickly scaled up. Their data centers use top-tier Nvidia GPUs, making them a go-to provider for AI startups, biotech firms, and even big finance. By mid-2024, CoreWeave had secured billions in funding, reportedly reaching a $19 billion valuation. All eyes were on them. The narrative? This was the company building the future's digital engine room. But then, boom, the stock dropped hard. Why? Here are the key pressure points. 1. Lofty valuations. Many believed CoreWeave was overvalued, priced more on hype than on proven profitability. When the market started questioning the fundamentals, the stock took a hit. 2. AI saturation concerns. As more AI startups compete for limited GPU resources, demand expectations are being reevaluated. Investors are now wondering, was this AI gold rush priced in too early? 3. Market correction. The broader tech sector has been volatile. With higher interest rates and tighter capital, speculative plays, especially those still operating at a loss, are the first to suffer. 4. Over-reliance on Nvidia. Yes, being an Nvidia-backed startup brings prestige, but also risk. If Nvidia shifts priorities or cuts supply, CoreWeave could lose its competitive edge. This crash could be a sign of larger industry corrections. We've seen it before. Tech companies with strong stories but weak financials hit hard during corrections. But let's be clear, CoreWeave isn't bankrupt. They're still operational, still expanding, and still securing contracts. The real question is whether the company can transition from a hype machine to a stable infrastructure provider. This crash might simply reflect the reality that even promising tech companies need to show results, not just potential. For some, this is a warning to be cautious with overhyped names. For others, it's a classic dip worth considering. Let's talk about Nvidia. They didn't just invest in CoreWeave, they partnered. CoreWeave is one of the few companies directly integrated into Nvidia's AI ecosystem. They have access to rare high-end GPUs and exclusive support that most competitors can't dream of. So far, Nvidia has not backed away from CoreWeave, which could mean they still believe in its long-term potential. And let's face it, when Nvidia believes in a project, the market usually follows. Still, that close relationship is a double-edged sword. If Nvidia shifts strategy or pulls support, CoreWeave could struggle to maintain its infrastructure pipeline. So what's the verdict? Is this crash a buying opportunity or an investor trap? Opportunity signs. Still in a growing AI infrastructure sector, Nvidia backing hasn't wavered. Long-term demand for GPU-powered computing is expected to surge. Warning signs? No clear path to profitability yet. Overvaluation hangover, tied closely to volatile AI markets. If you're risk-tolerant and believe in the AI infrastructure thesis, this could be a discount worth exploring. But if you're a dividend-focused investor looking for steady income and lower volatility, CoreWeave might not align with your strategy just yet. If you're watching CoreWeave, here are 3 things to track. Revenue growth. Are they turning contracts into real income? Partnership updates. Any signs Nvidia is expanding or reducing involvement? Profitability roadmap. Watch for announcements about break-even timelines or new funding. Remember, crashes don't always mean disaster. They can also be opportunities, but only when paired with strong research and a clear understanding of your investing goals. So, what do you think? Is CoreWeave stock crash a warning shot or a golden ticket for patient investors? Let me know your take in the comments. If you found value in today's breakdown, do me a favor, like this video, subscribe to Dividend Dreamer, and hit that notification bell so you never miss insights on the biggest moves in tech, finance, and dividends. Until next time, keep your strategy sharp and your dreams smarter.